This is the FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Today, farmland values and rental agreements in Illinois for 2026. We're joined by Nick Paulson and Gary Schnitkey, agricultural economists from the University of Illinois. Our topics for the day include farm returns and income, cash rents, farmland prices, and of course, there'll be some observations along the way. Now, let's start with a poll for you. You're going to fill this out. Which best describes your interest in farmland? Are you a farmer? Do you own farmland? Meaning you don't farm, but you're a landlord. Are you simply involved in agriculture as agribusiness, lender, policy, farm manager, things like that? Or you're just interested or curious? Go ahead and fill that out, and we'll see the results and get those back to you in just a bit. Jim Baltz is following along. Thanks, Jim, for being behind the scenes and making sure that this all works really well. Jim's always here with us. He's just never or rarely on camera. I don't know that I've ever, has Jim? Oh, no, Jim, I've seen Jim on camera at least once. When things, if you see Jim on camera, things are not going well for us. How about that? So hopefully we won't see him today, but thanks to Jim as well. So let's go ahead and in that poll and see where we're at. It shows us that we have 15% farmers with us, 53% of farmland owners, 29% are simply involved in agriculture, and then there are 3% that are just interested or curious. Thank you for being along with us for the day. We appreciate that. Another poll coming up. This one is, what do you expect the cash price of corn to average over the next year? So this should be an interesting one. You think it'd be less than $3.50? Between $3.50 and $4, between $4 and $4.50, and over $4.50. You didn't put the spread in that I thought might be work better. I wanted a dollar spread between $3.50 and $4.50. I figured that would capture it all. Well, we'll see how everybody else thinks about this as we get these numbers done. Actually, I was thinking 320 to 4 or 380 to 420 will capture a lot of it. We'll see how this all goes. And it all depends on what USDA has to say in October and how the tariff situation continues to unfold as it's related to policies. Go ahead and in that one, so 52%, about half of you say between $3.50 and $4. That'll be the average cash price. I was not thinking about that as cash prices. I think I'd be in that range on cash prices as opposed to December.
So as we go through this, you're going to see that a number of people were asked the same poll, and the majority of people are sort of in that same area. So everybody seems to have some expectation of $3.50 to $4. So
indeed they do. So I'm going to take some time. We're going to shut off our camera. We'll get started. Gary Schnitkey is with us, of course. He's going to take farm returns and income to begin with. Gary, thank you. And the floor is yours.
Yeah, thank you, Todd. And thank you for being here today. I'm going to start here with farm returns and incomes, and this obviously sets up what we think are going to happen to farm rents and farmland prices. This is the fundamental factor that determines sort of what levels we can think about for cash rents and those sort of things. We are going to start here with the there we go. We're there. There we go. So this slide shows corn and soybean prices going back to 1990 and up to 2026. So that 26 number there you see is 390. That happens to be the last USDA WASDE projection, which was last week. So they came in with a price of 390. That was in the range where most people were thinking about. We could have asked for soybeans as well, and soybeans WASDE is coming in with a $10 price. A couple points of that is a marketing year price. So we're just beginning that marketing year. This is the first month of that marketing year. And we have a long way to go. And the first projection the final price can change dramatically, just so we all know that, and many people are hoping that does change dramatically and dramatically up. A couple other points here is that we are continuing to come off those highs that we happened in 2020, 654, and now we're at 390. One of the items that we often note when we do these price series is the price plateau since 2006. If you average all the prices since 2006, it's averaged 445 for corn, 1065 for soybeans. And I ascribed, and many economists do, I'm not alone in this, Scott Irwin would be in this, Darrell Good would be in this boat, that there's long-term averages or plateaus where prices revolve around. We're likely at a 445 price. We got there in 2006, 1065 for soybeans. And that new higher plateau happened in 2006 because of the ethanol build. That was the primary factor that led to that. Before that, we were at 240 corn, $6 soybeans. And I could take you back into the 1970s and show you the one before that. But most people we're not alive, and that just shows that I'm getting old. 445 for corn, 1065 for soybeans. And that 390 corn price, $10 soybean price is actually not as low as we had from 2014 to 2019. The last time we spent a considerable time below this price. So if you think the price plateau hasn't changed, we can in fact get lower if we do have some supply, high yields and high supplies would take us down there. The other thing that I would say is that this is typical for commodity-based agriculture in the U.S. We spend short amounts of time well above that price plateau, and then we can spend considerable time below that, and we're probably in one of those periods where we can spend below that. And whether we spend 1 year below that from here on, because we've spent a couple of years below it already, 1 year below it, 2 years below it, 5 years below it, it's all unpredictable. All right. So we're at 390 for corn, $10 for soybeans. We would the majority of the people in the poll were at those same levels, and the majority of people in other polls were at those levels as well, and USDA is at those levels. So we sort of have a consensus there. One note, and this is the heart of our issue currently. We're looking at $390 for corn, $10 for soybeans, coming down off those highs. Costs have not come down as much as prices have come down. Here you see cost. This is a production cost for Central Illinois. This is 50-50 corn soybean rotation. It goes back to 2000 and up to 2026. We are projecting those for 2025 and 2026 still. We reached a high in 2023 of over $1,000 per acre. That's, by the way, a blend of corn and soybeans, so corn would be much higher than that. Soybeans a bit lower. 697 of that was non-land cost, and 359 was cash rent to get us to the total of 1,052. You will note that that went up considerably from 2020 to 2022. It followed commodity prices up like it always does. I would also note that period was a period of high inflation. COVID was in there, and that increased our machinery cost, and really no one is expecting those to come down. We're coming in with a projection of 648 for 2026, which would be lower than that high in 2023, primarily because of nitrogen fertilizer prices, nothing else. And we are actually increasing those from 2025 to 2026. Fertilizer costs have gone up. We see some softness, or not downward movement, but maybe constant movement in seed and pesticide. Machinery is not going down. So that's where we're at. Other thing to note there is our cash rent. We're coming in with a 327 projection. This happens to be for cash, our cash rent number. Given those situations, here is what our returns to cash rent farmland then look like. You'll notice there that we had, and this is cash rent. So this is a 50-50 corn soybean rotation. Cash rent, the average cash rents were given in the previous slide, but we had higher returns in 2020, 21, and 22. 21, we had the highest return on record, $314 per acre for farmer returns. But since 22, we've seen negative numbers, minus $47 for 2023. 2024 came in with a projection of minus $42. That would have been $37 lower had we not gotten ECAP payments. And those ECAP payments, if you remember those were legislated in December of 2025, paid in March and April of 2026.
Back up a year.
I'm sorry. Legislated in December 2024, paid in March of 2025. So that's that $37. We put that with the 2024 crop, even though it was received in 2025 because it was associated with the 24 crop. We're coming in with a projection of minus $36 for the return in 2025, and that includes revenue from $65 of ARC PLC payments. A note here, that will be received in October 2026, so that's a year away. There's not likely to be many ARC PLC payments this year, which would be associated with the 2024 crop. So that $65 is obviously a projection, but that's a year away. The 2026 return is minus $33, and that also includes $50 of ARC and PLC payments. Those government payments have been important in our farm returns and are included in the returns in these bars that you see here. This is what they look like since 2015. And we've divided those out between ARC and PLC payments. We had high ARC payments for the 2025 production year, 2016, 2017, and 2019, and then again in 25 and 26 with $5 we're projecting for 2024. Just an item to note there is we've had high ad hoc payments. In 2018, that would have been MFPs. 2019 and 2020, that would have been CFAP payments, as well as some MFP payments in 2019. In 2024 is that $36 of ECAP payments. Those are critical in those return. I also note those because there's some discussion that there could be another round of those for 2025. So that may be stacked on top of that $65. There's some discussion of that. There's also some discussion that we could move up the payments on ARC and PLC and make them earlier. We'll see what sort of legislation happens. That then leads to this farm income projection. We hit our all-time high in 2022 of $506,000 per farm. These farms here are average in FBFM. It's about a 14 to 1,500 acre grain farm, 20% owned, the rest is rented. We hit 76,000 in 2023, 13,000 in 2024. That $13,000 positive number includes those ECAP because FBFM put those on as a payable. So, and then 45,000 projection for 25 and 26. Those projections for 25 and 26 will not result in appreciating financial position. You generally need $90,000 of net income to cover family living, debt payments, and those sorts of things. So that's going to result in deteriorating financial positions, lower working capital in many farms, higher debt to asset ratio. So just to summarize the economic environment here, corn prices are near $4 and soybean prices are near $10 per bushel for the foreseeable future. We don't see anything that's going to cause those to change, right? Having said that, they could change tomorrow if something surprising happens, but that would be an unpredictable event, and we're here. So cost of increase since 2020, and we have much higher break-evens now. If we get no government payments, we need $4.50 for corn and $10.50 for soybeans to break even. So did the government contribution include the SDAP payments just received for 23 and 24? We haven't put those in yet.
No, and I think, so these would be the supplemental disaster payments, and there's information about those. There was kind of a multi-phased way that farmers might receive those disaster payments for losses in 23, 24. There was losses that were eligible, counties that automatically received them, kind of fast-track the payments because they had drought conditions for a minimum amount of time during those years. When we looked at that, we do not have any projections in there yet. I don't think again, we're talking about averages here when we show you these numbers. We just don't see there being a significant average payment going out to Illinois. I think in at least one of those years, I don't think any of the Illinois counties even were eligible for that kind of phase one fast tracking based on drought. So there will be some payments, but they won't be on average anywhere near. On individual farms, they can be important, but they won't be anywhere near some of those averages we were looking at for ARC PLC or the ad hoc programs.
Yeah, just as a reminder, if you have questions, go ahead and click that question mark box that's up at the top right-hand side of your page. Put them in and we'll get them answered as quickly as possible. Time to move on to cash rents.
All right.
Nick?
Yeah, and we're going to do a poll on that
Well,
first.
let's do that first. What do you expect to happen to cash rents in 2026? You expect them to decrease, hold steady, or increase? So what do you expect to happen to cash rents in 2026? Decrease, hold steady, or increase? If you've been listening to the closing market report earlier in the week, you would have heard an answer on this question that came from Todd Keithy, actually, at Purdue. So we'll see what he has to say. And it may depend on which state you're in. Go ahead and close that out, and we'll take a look at the poll and see what the answers look like. 38% say they'll decrease, 58% say they'll stay the same, and 4% say they will increase. Any commentary from the two of you on which direction?
So that's about what I would expect. I think that's sort of the sentiment we get regardless of who we talk to. We joked about asking kind of who the audience was at the beginning, because that would determine which set of slides we presented this morning, whether we thought cash rent, which direction we thought they would or should go. But so I'm gonna just warn you, this tends to be a topic we get some interest in every year. We love talking about cash rents and where they should be going. We're going to present information on the best data sources we have available on where they have been going. And we want to remind everybody that these are averages, or in some cases, they are responses to surveys, so informed professional opinions. And we're going to present the information as we have it. So the first one we're going to look at, the source here is the USDA. These are the average cash rent series that they put out every year. So these are statewide averages. We include all 3 I states here. Iowa tends to track a little higher than Illinois. Typically, they move in the same patterns and trends through time. Indiana tends to be a little bit lower than Illinois. But again, they tend to move together. Across all 3 I states from 24 to 25, we saw a decline in average cash rents. Again, these are statewide numbers. Individual farm level or tract level experience can vary. Illinois did see the biggest decline in their average, down $5 from 269 to 264. Indiana was down $1, and the Iowa series was down $2. So again, some evidence here that the cash rent market is facing some downward pressures. And again, we provided the context or the reasoning for that with the intro on kind of the economic environment. Number of questions here coming in. Yes, the presentation will be available to review. It will be on YouTube as a recording of the whole thing, as well as downloadable from the archive on the FarmDoc or FarmDoc Daily websites if you navigate to the webinar tab. Is the $327 cash rent per acre for professionally managed farms? The $327 per acre, assuming you are referring to the number in our series in Gary's section of the presentation, that is an average for Central Illinois. Some of those farms could be professionally managed, but they are not exclusively professionally managed. Those are grain farms enrolled in Illinois FBFM. The 327, however, I would caveat that with, that is our projection for 26. I think that was the number we had. Again, I'm assuming that's what you're referring to, but all those historical numbers are from grain farms enrolled in FBFM, and we obviously use that historical information to inform our projections. But you can blame that number on Gary and I in terms of kind of where we think they're headed.
Just to give you a feel, that was 337 in 2024. And again, that would be across Central Illinois, high productivity farmland. 332 in 2025, and we're coming in with a projection of 327 for 2026.
There are a couple of questions I think we can combine that are related to FSA, ARC, and PLC. Somebody wants to dig deeper into the ARC PLC discussion and understand what would have to happen for those to move forward. And then the secondary question there is the ad hoc difference between the ARC and PLC payments and ad hoc payments, and whether they are all subject to the AGI limitations or aggregate the gross income limitations. Do we know?
So to look at ARC PLC, for those payments to be moved up would require legislation. So that would require a specific legislative act. It would also require something to be done with, so it's a market year average price that determines payment. So you would have to make a projection of what the market year average price payment would be. I personally think that this would be relatively easy to do this year, because you're supposed to be getting the higher the ARC and PLC payment, just make the PLC payment, and if the ARC payment turns out to be higher later, then
USDA has a monthly season's average cash price that they could use.
Yeah, I mean, and then to be honest, anything that we throw out here as a potential way that they could do that is pure speculation.
Us.
We have ideas. If we were made king for a day and could make those decisions, maybe those are the things we would suggest implementing. But don't interpret that as we have any key inside information about what may happen. Because we do not, but one would think though that you could use an estimate given all the market information that we get. USDA puts out estimates of those prices that are going to roll out in reality over the marketing year starting now, and so one would think you could advance some payments based on those. Would it be easy? Maybe not. Could you do it? Yes. How? To be determined.
by the way, the AGI limits vary across programs. So
yeah, so the ARC PLC programs are, what I refer to sometimes as standing programs. They're the commodity programs defined in the Farm Bill. They have specific income limits associated with them. Real quickly, some other questions here. How sticky are cash rent prices? Vary, and even more so on the downside. They tend to adjust up to conditions quickly, or larger adjustments on the upside than we tend to see on the downside. What caused rents to change in Bureau County from 24 to 25? In Bureau County, it looks like they went up. There were some rents that went up, some rents that went down. We're going to get to that here in the next slide. These are survey responses. And so part of it could just be sampling variability year to year. But there's, all sorts of reasons why average rents, and this is not to say the survey methods are bad or wrong in any way. It's just there can be variation from year to year. And that's a collection of individual farms that responded. And so, in general, I think they give us a good direction of where things are headed on average. But they can be impacted by the individual responses that are in that survey data. On those Illinois county cash rents, that question must have been a fortune teller, because that was our next slide. So again, these are USDA rents. These are survey-based averages of actual farms. And these are released by the National Ag Statistics Service. And again, that statewide average came down. Rents did not go down in every county. On average, rents in some counties went up. But if we look at, the 102 counties and the 80 some counties that I think had enough survey data to publish an estimate, we saw more of the counties in Illinois with a lower average cash rent for 2025 than they had in 2024. Again, not all counties saw declines, but more counties saw declines than saw increases in those average. And the map there just shows the standard regional pattern of the greens are counties that have an average rent higher than the statewide. The reds are ones that have a county average lower than the statewide for 2025. And we just see higher rents in most of central and northern Illinois because of soil productivity and yield potential. Lower rents in southern Illinois. Another source of information that we follow and look to on rents and farmland values is the Illinois Society of Professional Farm Managers. This table actually has a combination of information sources in it. So the column in orange and the two columns in blue are yield information in orange, and then average rents by soil productivity class. That's a calculation that we did, but it's based on the NASS county rents and the average soil productivity ratings in those counties. And those are provided here. We want to focus on the right three columns, and that is the rents on professionally managed farms that were provided in the Illinois Society's latest update. And you can see the excellent and good classes, the higher soil productivities areas associated with higher corn yields and higher soybean yields have seen rents come down and are expecting to see rents come down again in 2026. On the average class, we saw rents hold fairly steady from 24 to 25, but are expecting a decline in 26. Again, that's an opinion survey, but these are professionals in the area, so very informed opinions. And then for fair quality land, we saw the average rent actually come up a little bit from 24 to 25, but with a decline expected for 2026. We always like to point out that professionally managed rents do tend to be higher when we look at averages versus more general averages, like from the USDA or FBFM. There are various reasons for that. We also tend to see bigger movements in those rents, whether they be upward adjustments because of good profitability or downward adjustments because of poorer profitability, which is the situation we're in right now.
Yeah, the other thing that has been pretty consistent across those two surveys is the average and fair productivity classes or land classes. Both went up from 24 to 25 on the average side, and then the Illinois Society results also tended to confirm that. So, whereas the excellent and good tended to come down. So we've had some dichotomy across the land classes, which also has a geographical distribution to it.
Again, more information here on this next slide from the Illinois Society. So again, professionally managed farms, their mid-year survey, which Gary helps administer and then report on. And that came out in August, was I think released at the Farm Progress Show, as is typical. And participants in that survey or respondents do expect, again, cash rents to come down by an average of $15 to $20 per acre on those professionally managed farms. And their price expectations, as Gary pointed out, are very consistent with what USDA is at, what our audience today is at, kind of around or just below that $4 level for corn, and around or just below that $10 level for soybeans. So again, just trying to show that, your price expectations tend to be consistent with the information sources we're using here that are indicating where we're seeing rents have gone and where they might go into next year. With that, I'll turn it back over to Gary on farmland values, and I think we have a poll that Todd's going to help us run here on farmland prices.
You bet. So here's our next poll. What do you expect to happen to farmland prices in 2026? To decrease, hold steady, or increase? Go ahead and take that poll. I think there were a couple of things that we could answer while they're doing the poll.
So
On the county slide, there are little stars. Somebody wanted to know what those meant.
Yeah, so the stars, it indicates that on the map. Those are not a lot of information, but they're estimates that we put together. Again, these are survey-based estimates. USDA has, and for very good reason, statistical standards that have to be met before they will publish an estimate based on surveys. They basically need to have a sample size they're confident in. If they don't get enough responses, they don't publish an estimate. Gary and I used a simple statistical regression relationship between soil productivity and rent levels to kind of fill in those gaps. Again, those stars, though, it is good to point out, those are not official USDA numbers. Those are FarmDoc or even Gary and Nick numbers, if you want to really throw individuals under the bus.
Yeah, so I think you answered this question and it just now. For the county rent survey, is there an average SPI per county behind the numbers?
Well, I mean, I don't know what
yes
that means.
No.
Is there a number behind that? The county rent surveys, they survey people in the county.
Those are USDA numbers.
Those are USDA numbers.
So the answer is
we have SPI information. Our colleagues in crop sciences have the ability to sort of put together average SPIs at the county level based on all the soil types in that county. And then we combine those together to kind of categorize counties. We have an average SPI number that we use, but the survey is the survey of people in that county.
Let's move on. We have some answers. Jim Bolts has closed out the poll. It shows that 36% say they expect the cash rents to decrease. Half of our audience says it'll stay the same, and 14% says it will increase. Was that, Gary, in line with what you thought that poll might show?
So that is pretty much what we expect, or I expected that poll to show. We're going to go over farmland values right now, and you're going to see that the evidence is more mixed on where farmland prices are going than cash rents. First, starting out in farmland values in the I states, $9,850 was the average cash rent in Illinois, according to USDA. I'll remind people in northern and central Illinois that southern Illinois is a part of Illinois, and that the prices are lower in that part of the state. $10,300 in Iowa, $8,250 in Indiana. I would note that this survey just came out. It was for 2025. It came out in August, actually. And they continue to see rising farmland prices. So from 24 to 25, USDA is coming out with those prices increasing. So that's one set of information that shows that information. The Federal Reserve Bank in every year also does a survey of Midwest farmland values. They came out that it continued to grow in the second quarter, and these numbers here show the percent change in value. There's a minus 1% there for Illinois. That happens to be for April through July, and then their estimate at the bottom is constant land prices between July 1, 2024 and July 1, 2025. So USDA had that going up. The Fed has it remaining the same. Their survey is of lenders in the area, so different lenders. I would note that there is a difference between Illinois and Indiana. 3% up for the year. You're going to see that kind of somewhat consistent, and 7% up April through July. And then you go to Iowa, and they look more like Illinois in the first or the most recent quarter, and more like Indiana in the longer time series. And then you see Wisconsin there as well. So that's the Fed look at it. Here is what the Illinois Society of Professional Farm Managers said at the end of 2024. So this would be at the end of 2024. We're going to show you their mid-year survey results, but they came up with excellent productivity land, $16,500. That's down 2%. 12,416 down 4%. So they're having the excellent good productivity classes going down, average and fair going up. So again, we see that average and fair continuing to go up, and the excellent and good, according to this survey, coming down.
And maybe just note that, the bigger percentages there you see, just, it says in the table, but just to clarify, that's a total change over a 4-year period since 2020. So obviously, or maybe not obviously, but there's been some pretty significant increases in farmland values across productivity classes in the last 5 years. And that parentheses number is that total change over the 5-year period. The first part in those parts of the table are the annual changes from 23 to 24.
Yeah, it's pretty safe to see that the more recent changes have been really modest compared to the increases that we saw from 2019 to a year or so ago. So this was what the Illinois Society was looking at the end of 2024. During the first half of 2025, respondents reported a decline of 2 to 3%. So they were expecting those land prices, or they observed that those land prices declined 2 to 3%. That's actually a modest decrease. So again, a modest decrease. And here is their percentages, which almost match what the poll said. 33% expect stable prices, 49% expect declines of greater than 3%, 18% expect declines greater than 3%. If anything, this poll may be, the Illinois Society may be a bit more pessimistic than the first poll of our group here, but still 33 and 49% are expecting stable to less than 3% decline in prices. So we asked this group, all right, let's look out a couple years. What do you expect farmland prices to do in the next couple years? 23% expect higher prices, 44% expect the same prices, 33% expect lower prices. So they're really divided.
And a weighted average would project stability.
We asked a number of questions, do they expect large declines in prices? And very few people are expecting large declines. I would interpret where we're at as sort of a plateau, where you're expecting prices to remain roughly the same, to maybe just decline a bit, maybe increase a little bit, but just sort of here. Purdue released their survey here last month, and they saw top quality land increase 3%, average quality land increase 5.4%, poor quality farmland 7.6%. Indiana, for whatever reason, and a number of polls suggest this, is that they're seeing farmland prices increase more. That may have something to do with development around Indianapolis and the spreading, or the spreading impact of that development. One of the things that we look at a lot is the current return from farmland, which is the cash rent divided by the cropland price. And that's a blue line here. And that's been steadily going down over time. And it was at 2.7% in 2025. So this is, you can look at this as the current return to farmland. This is the cash rent divided by cropland price. Obviously, there's a property tax and ownership cost to take out of that, but that has been going down to 2.7%. We know the strong relationship between that and the 10-year constant maturity treasury rate. And if you look at it since the 1985, those two have tracked each other closely. And if anything, we're above that now. That would suggest that, something needs to happen, likely that would happen, that would cause current return to go up to that 4.4% level. There's two things that can happen. Cash rent can go up or farmland prices can come down. We use this to go back to the 1990s. And if you remember, during that period, we saw farmland prices decline 40 and 50%. There was a huge disconnect between the current return and 10-year constant maturity treasury rate at that point in time. We aren't anywhere near that level currently, and we've seen these sort of in 26, 27, 1996, or we're not at levels that would be concerning, but just simply know that the current return level and interest rate level don't support increases in farmland prices in its current environment. Again, nothing concerning there, but just note that does point to stability, to slight declines in farmland prices.
I think particularly when coupled with the fact that returns just don't suggest a lot of potential for big increases in cash rents. So again, that ratio, if you think those series and markets work and those series sort of have to, for whatever fundamental reason, have to sort of be in line with one another, just kind of signaling that, there isn't probably there's more headwinds than tailwinds on farmland prices right now.
All right.
So now we've got some of our, again, I don't know if Gary and I would call any of these earth-shattering or world-changing observations, but a few points here to make based on all the numbers that we've looked at. I guess, where are we at on time? Maybe should we try to tackle a few of these questions just so they're get them out of the way before we move on here?
Do you know if the majority of cash rent agreements, the tenant and landlord share expenses such as tiling and limestone? So under a cash rent agreement, the tiling would be the landowner, not the farmer's expense. Limestone is an arguable one. Often the farmer will put it down, but then there has to be an agreement put in place that they will farm it. Lime lasts 4 to 5 years. There would have to be an agreement put in place that if the landowner, for whatever reason, rented to another individual, that farmer would be compensated for that lime. Number of cash rent, there's a division there on what to do with lime.
A couple, at least, question here on how do variable cash rents play into some of these cash rent numbers that we show you. There's more and more of these variable hybrid flex style leases that are still considered cash rents, but the rental payment does vary based on maybe a formula based on revenues for the year, price levels for the year, maybe even some might even incorporate some cost measures as well. There is no one single variable rate cash rent really to point to. We're showing, to answer the question, the surveys from USDA, presumably people are answering what they actually paid in cash rent. So that would maybe include the bonus for that year. So some of the, in terms of where this question is going, I think, bonus payments, I think you could probably say are included in a lot of cash rent numbers. I don't know what the Illinois Society numbers, Gary, if they distinguish in those a little bit more in their survey results.
Yeah, they do. The cash rent number is supposed to be a fixed cash rent number.
But I do think the USDA, again, depending on how the respondent interprets the survey, it very well could include some of those bonuses. And so some of those cash rent declines in those averages could just mean smaller bonuses have been paid because revenues have been down with lower prices. But again, there's no direct answer there that we know exactly every survey respondent knows they should only include a base, or that's what they're instructed on, or anything like that. What about those society rents, Gary, in the survey? What about management fees? Are they included in those?
Management fees are taken out after the rent, so that's the gross rent that is reported.
Let's see. Is it questions here are tough to answer?
A couple of them certainly are.
Well, these are all tough to answer, but question here on the impact of solar and wind. That's a touchy subject. We talk to people on that. You got to be careful how you answer this question. It does, so far, the amount of acres that are being impacted by this do not have a significant impact on averages that we see at a national or I would even say a state level. But the localized effects of these things can be much bigger. I mean, if you get a solar company, a wind company, and they're all of a sudden involved with 1,000 acres or more in a county, that is going to impact the going rate for cash rent in that area. Is that going to translate to averages we see at broader geographical scales? No, but they do and can have big impacts. And especially if you're a farmer who wants to rent that specific piece of ground, that does have a very big local impact for you. Gary, I don't know what else.
Yeah, no, that would be, I would expect those projects on a farm where they exist to have more of an impact on farmland prices than on cash rents or rental rates. But
let's see here. What else do we want to cover here? A few more questions. Elaborate on why these factors don't support increases in land values. Well, again, if you're focused on that, how kind of that current return series tracks that 10-year maturity treasury rate, I look at that 10-year maturity treasury rate as kind of an indicator of the interest rate market in general, and also as sort of an alternative return. So, from an investment perspective, not that outside investors dominate the farmland market in any way, but if you have, X amount of dollars to sink into an asset and you're looking at a 2.7% return asset versus a 4.4%, pretty low risk asset in the 10-year CMT, that might just kind of reduce some of the push for higher demand and higher farmland values. There's other ways to look at that. Gary, I don't know what else you have to.
No, that would cover it. Again, I'm just saying, interest rates going up don't results in all asset values downward pressure being put on those. We might be seeing some declines, or the Fed did announce an interest rate cut last week or this week. Yesterday. So that may have an impact of lowering rates. We'll see if they carry through with that, and also whether those in fact do, if the Fed cut translates into the Treasury bill rate coming down.
Another question we got is just on how taxes, or maybe how taxes differ in different states, how they might affect land prices. Obviously, property taxes are a cost of ownership associated with an asset like farmland. The higher the tax rates are in your area, the more negative effect that would have on land values in general. We don't see a lot of, I don't think that's a driving factor in different land values that we see. I think productivity, yield potential is a much bigger factor than property tax variation.
We have 10 slides and 10 minutes left.
All right.
Put your observations together.
Let's move on to our observations. So again, a summary point here really is just that, the economic environment is such that we are seeing pressure and honestly, probably some justified pressures for reductions in some of the cash rents we're seeing out there, but those adjustments historically and would expect it to be in the future fairly slow on the downward slide. we're going to, again, kind of have to see what happens with ad hoc federal payments. Our view on that, or at least my view, is, those are, maybe necessary, maybe helpful in the short term. I don't know how many favors we're doing ourselves in the long term with those, in terms of how they maybe continue to support prices and values that are maybe a little bit out of line with fundamentals. That could be viewed as a hot take. I don't know. And another point we wanted to just quickly take you through here is that variable cash rents are something that kind of have emerged in my professional career, 15 to 20 years, become more popular, an alternative to the more traditional share rent that does build in some risk sharing on the variability we see in agriculture between the landlord and the tenant, maybe without some of the decision-making, sharing, and other headaches that can be involved in a share rent, particularly if you've got a landlord that maybe doesn't want to be involved in some of those production decisions. But the current environment we're in, the variable cash rent isn't really addressing these negative returns we're seeing here to cash rented farmland. So again, this is the same chart we showed earlier, the negative returns in 23 and 24, projected for 25 and 26. If we look at, again, this is an example of a variable cash rent agreement. This is one that we've written on FarmDoc in some articles. It's based on a revenue percentage that is shared between the farmer, tenant, and the landlord. And kind of what we see there is because the costs are high relative to where our prices are at, even that revenue sharing aspect of a variable cash rent isn't necessarily addressing the negative return outlook here, or even what was experienced in 23 and 24, even in a variable cash rent situation.
And just to give you a feel, those revenue factors would be 31% of the revenue for corn, 32% for corn, depends on the region, 42 to 43% for soybeans. Just to give you a feel, that typically over time has caused the share rent and variable cash rent and cash rents to equal one another over time, with differences across time. Again, we see that those still resulting in negative returns in the current environment.
And then even the share rents, which again, from the farmer's perspective, does improve things in poorer return periods, because there's that sharing typically both on the revenue side and some of the direct costs. But even in kind of a traditional 50-50 share rent, where we're splitting revenues and splitting direct costs, which include inputs, crop insurance, things like that, some pretty low returns here, just above break even with that traditional share rent from the farmer's perspective since 2023. So, and we've got a couple slides here with what some of those rent levels under those different example lease types would look like. And so you see in periods of high returns, high prices, high revenues, 2020, 2021, 2022, you see the share and the variable resulting in a net rent payment back to the landlord that's bigger than what we see in fixed cash rent. Then we see things adjust, costs go up, rents come up, and then prices come down there. We see those share and variable rent levels go below that prevailing average fixed cash rent level. And again, so like Gary said, on average, we tend to see those things perform pretty similarly through time on average, but they just tend to differ year to year based on the economic conditions that we're seeing. And you can see the differences there. Years 2020, 21, 22, where rents to the landlord were higher on that variable and share, lower than the fixed cash rent level in the more recent years with the lower prices and continued high costs. So related to that, we did want to directly kind of make this observation as well. We're just in a situation where if you're looking at a farmer and a landlord, there just isn't really an operator and land return, a return back to the farmland that can really be split between a farmer tenant and a landowner that gives either party really an average, something close to kind of what we see in terms of average historical returns. it's a tight margin environment, and it's just it's not that one side is necessarily doing great versus the other having huge losses. There just aren't a lot of dollars to share right now.
Yeah, and that's that is driving a lot of the difficulties now. And simply put, if you lower cash rents, obviously the return to the landowner goes up. That helps the farmer. But even if we would have to see rents go back to 2019 levels, and even then farmers would not be as well off as the 2018 to 2020 period, because costs have gone up.
Yep. And so kind of our 2, 3, and 4 points here. Again, our first point was just on the downward pressures on cash rents in general. Again, Gary and I think would very much agree with kind of a stability in farmland prices moving forward here in the short term, maybe some slight declines, but nothing significant. Still a lot of interest on the demand side. Farmland goes up for sale. There are still interested in willing buyers out there. There are some lenders that are getting concerned. I think last year's operating loan renewal period was different than it had been in previous years. I think this year was a repeat of that. We had a strong financial position in general on most farms at the end of 2023, very strong position on many farms, but that has deteriorated. And there are definitely some financially vulnerable financial situations out there.
Yeah, and those decisions will begin to be made soon, and some farmers will likely see operating lines not as big enough as they would like, and then that will force decisions as well.
And then the final point we've made a few times, again, we're always looking for that next surprise, positive movement. Keyword there, surprise. If it wasn't a surprise, we could tell you when it's going to happen. And I, again, not to be too pessimistic, I just think there isn't an obvious sort of thing to latch onto out there where we can say that there's even a reasonable expectation of where that source of that surprise positive movement might come from. Obviously, weather can affect things. We'd some like to see, I don't know if we'd like to see, but see, poor production in other parts of the world. Competitors could move markets, but when that's going to happen, where that's going to happen is tough to predict, and anyone who tells you otherwise is maybe not being honest. All right, so to wrap up and summarize here, and if we have a minute or two for questions, we'll try to hit a few more. Again, just economic conditions right now suggest downward pressures on rents, headwinds for farmland values. Farmland market does remain very stable, but there are some expectations for continued stability to small reductions into 2026. And maybe the last point here, which is maybe a big one to throw out at the end, I guess, but we do tend to see again in the data when we look at farms in Illinois, owned farmland does provide a really good return or income buffer, particularly or specifically in some low return periods like we're in right now. But we're very aware that access and ability to cash flow, farmland purchase remain major constraints for most potential buyers out there. So owning farmland and having it paid off is great, but in terms of getting there, that can be a difficult 20-year process to get to that point.
We will try to get a couple of more answers to some questions, but we do want to take some time to thank our sponsors. They include the TIA Center for Farmland Research, CoBank, Compeer Financial, Farm Credit Illinois, Growmark, the Illinois Corn Growers Association, the Illinois Soybean Association, and John Deere. Our educational partners include, of course, the College of Agricultural, Consumer, and Environmental Sciences, along with the Department of Agricultural and Consumer Economics, University of Illinois Extension, the Gardner Agriculture Policy Program, and FBFM, the Farm Business Farm Management Association in the state of Illinois. If you'd like to see this program again, you can always do that easily enough at farmdocdaily.illinois.edu. Look under the webinars section, or you can find us on YouTube, Facebook, and X. YouTube's really simple to do. By this afternoon, Jim Baltz, who's behind the scenes, Thank you, Jim, by the way, for everything you do. We'll have this up on our YouTube website at youtube.com/@farmdoc. Which questions that we have left? And I think we had 24 total. So we've got a few that we have not answered yet. Which questions do you want to take up first, Nick?
So how to get, we'll take the one we can't answer. How to get input costs to come down? I don't
You can
know.
answer that one?
You
No,
can.
Oh, I'm interested.
He said can't. He said
you
can't.
can't answer. Yeah,
Oh,
yeah,
can't answer it. Okay.
yeah. So our bushel leases common in the I states? No, they're not. We've seen those move to more variable cash leases, which doesn't necessarily mean if you're happy with the bushel lease, don't move from it. But we've seen not a movement away from bushel leases, and they were never really all that large to begin with.
I will say on the input costs, Gary, and we broken record message on this, but I do think you can make some changes at the margin. We always want to encourage farmers to take a look at their application rates for fertility and pesticides. There's look at the MRTN, compare that to what you've been applying in terms of nitrogen. I think there's some dollars to be saved there, again, at the margin on a $1 per acre basis. Another thing is on the pesticides, we're past that for the 25 crop, but it's a different decision on pulling the trigger on like a fungicide application. Obviously, if you got pressure, it might be needed, but $4 corn, that's a different decision than when we had $6.54 corn a few years ago.
The other thing is, on the machinery side of it, we saw those large increases in machinery in the 21-22 period. We need to go back and reevaluate those decisions. And the number of acres that are required to own, for example, a combine are up there. And if you're not in that sort of optimal range, those costs are extremely high anymore.
And it's hard to, apply a time machine and change machinery investment decisions that have already been made. And it's a tough ship to turn around on a 1-year basis, but just in an ongoing way, just sort of making sure that machinery you've got sort of match your farm size and things like that. We try to get one more here before we wrap up.
So yeah, which one do you want to do?
Mm-hmm.
Is it fair to add a premium to cash rent on irrigated land? Yep, it is. Now the question is, what should it be? And send us an email. We'll do a little research. That's not something that comes up all that often.
Does land value appreciation figure in your calculations? We think about land value appreciation. We think it's an important consideration from both the farmer and the landowner's perspective. In some cases, that's the same person. The capital return, the appreciation of land values should be a relevant factor. We understand that property taxes are increasing, other, cash flow type of ownership costs are likely increasing from the landlord's perspective. And so just saying cash rents need to come down by X dollars per acre is, we understand that there's a landlord side to that too. But I think, considering the appreciation of the asset value, the challenge with that, I think, from the landlord's perspective is in most cases, most farmland buyers don't view themselves as ever necessarily being farmland sellers. And so is that return ever going to be realized? Even if not, it is a positive effect on the individual's net worth and should be considered in terms of looking at the total return to the asset, not just what's coming in the current return from the cash rent.
So owning roughly if you can include the capital gains and differing holding periods, it's generally been roughly the same as holding stock market returns. And we can argue whether the risk return are the same there, but it's been consistent with that. Over time, farmland in Illinois has averaged a 6% capital gain. So, and obviously that varies across time.
I think on that happier note, we should close out the program. Thank you, Nick Paulson and Gary Schnitkey, for being with us, Jim Bolts for being behind the scene, and for all of you for joining us here for this FarmDoc Daily webinar. Be sure to visit our website at farmdocdaily.illinois.edu, and you can sign up for the webinars that are upcoming. I'm University of Illinois Extension's Todd Gleason.